90% of all Bitcoin's price action is explained by global liquidity. So for that to be true, that 2026 is a bear market year, it must be true that global liquidity is going to be falling. Memes went down 99%. More speculative stuff goes down 90%. The kind of newer stuff that's still high quality goes down 65%. Solana goes down 55%. ETH goes down 40%, and Bitcoin is flat. It's that whole thing, and that's what really kind of hurt everybody. Bitcoin today should be at 160,000. So that's the discount we are to fair value according to liquidity. So that was the feature of the year. It was a technical year because of what happened. It should have been a lot stronger finish to the year. But what we do know is we've got a lot of liquidity coming in 2026.
Right now, the crypto market is sending mixed signals and the overall setup feels unusually disconnected. Bitcoin is holding near $90,000 while most altcoins continue to bleed, leaving many investors confused by the divergence. Throughout 2025, altcoins collapsed anywhere from 40% to as much as 99%, meme coins vanished, and even fundamentally strong projects were cut in half. What was expected to be a momentum-driven year instead turned into a sudden liquidity drain, with billions erased almost overnight after a shift that began back in October. What makes this moment different, according to Raoul, is what lies ahead. He argues that 2026 isn't just another phase in the cycle, but the launchpad for what could be the final major expansion before AI and emerging technologies fundamentally reshape global markets. Governments are injecting stimulus, interest rates are falling, and macro indicators are flashing acceleration, yet Bitcoin is still trading roughly $70,000 below where liquidity models suggest it should be. Gaps like that rarely persist, and when they close, the move can be sharp and surprising. The bigger twist comes after that expansion. Powell warns that by 2027 or 2028, AI could advance so rapidly that today's investment and business frameworks may no longer apply. Software costs could approach zero, venture capital may lose relevance, and human-managed hedge funds could give way to self-evolving algorithms. If the rules of markets are about to be rewritten, the real question becomes what investors should be preparing for next.
Hey, I am Maria with DailyDoseCrypto. Have you noticed that gold, silver, and Bitcoin have hit all-time highs recently? Is this a coincidence, or are smart investors onto something? The dollar is depreciating, inflation is eating up all of our cash, and the US national debt is through the roof, hitting new highs every day. That's why people are shifting to alternative assets like gold, silver, and Bitcoin. We at DailyDoseCrypto have partnered with ITrust Capital, your one-stop platform to buy and securely store 80+ digital assets, including Bitcoin, gold, and silver to hedge your future against debasement. With over 200,000 accounts, 15 billion in transactions, and 11,000 plus positive reviews, they're helping real investors build long-term wealth with their tax advantage, IRA, and PCA, which is a premium custody account that supports the highest level of custody and security in the space. They do this all with institutional-grade custody through partners like Fidelity Digital, Fireblocks, and Coinbase Prime, keeping your assets secure while you can trade 24/7. Fees are just 1% per transactions with no monthly or annual costs. Getting started is simple. Sign up for free and fund an IRA or PCA today. You'll receive a $100 bonus and start growing your assets the smart way. Click the link below to open your account now and begin your journey toward generational wealth.
2025, as we all know, was a weird year because everyone was expecting a positive year, started really strong, then faded, and then fell apart later on in the year. And it was a story of liquidity and an extended business cycle, and it was a lot more technical because people just thought that there was this 4-year cycle and it just magically happens, and it doesn't work that way. Economic forces are what drives everything, and the major economic force is liquidity and the management of global debts. And what we found later than I should have found it was that the debt cycle had been extended by another year. And also the political cycle is really geared towards 2026. So last year, liquidity was being drained somewhat, but then what really happened was that October period when the government shutdown happened. And crypto got hit because of that massive liquidation on October the 10th, and it never recovered. And, if I look at like global liquidity versus NASDAQ, it mapped it perfectly. So the everything code worked perfectly for technology stocks, and then crypto, it didn't. So there had to have been something that happened within the crypto market, which was A, the withdrawal of liquidity. It's the furthest out the risk curve. It gets hit by liquidity. But also something structurally broke over that period of time. And we saw that big seller come in every single day. What that was caused by, nobody's ever going to know. Was it Binance who ended up having to backstop their own marketplace because there was no market makers because the APIs are broken and everything else are broken? And then they had to unload inventory? Who knows? I don't think we may never know what happened. But that disconnect, if we'd have followed the map as NASDAQ did perfectly, Bitcoin today should be at 160,000. So that's the discount we are to fair value according to liquidity. So that was the feature of the year. It was a technical year because of what happened. It should have been a lot stronger finish to the year. But what we do know is we've got a lot of liquidity coming in 2026. And also, just to go back to that, is the other thing people struggle with in their heads is, yeah, we can talk about Bitcoin, and Bitcoin was pretty flat. But then anything further out the risk curve gets hit more. And so, memes went down 99%. More speculative stuff goes down 90%. The kind of newer stuff that's still high quality goes down 65%. Solana goes down 55%. ETH goes down 40%, and Bitcoin is flat. It's that whole thing, and that's what really kind of hurt everybody. The dollar looks like it's gradually weakening again. So there's some simple things to look at to see where we are in the cycle. Are rates going up or down? Generally, the bond market's reasonably well behaved, and 2-year rates are going lower. So if you think interest rates are going down and the dollar's relatively weak, that's generally a good sign for the economy. As simple as that. It feels like a recession to people because it is in manufacturing. Mm-hmm. I mean, it has been. I mean, it's real. Yes, it's not in tech because they're having a boom time. They're not only cutting workers, but they're increasing earnings at the same time. So productivity is going through the roof because of AI. That's another management that they're going to have to do, is the AI narrative could run away with them, which is like, we're never going to create jobs because of AI. And then that becomes a real fear. But I think that, you can see them trying to manage it. And don't forget, it's not manufacturing jobs that go because of AI. They'll go because of robots. But they've been going because of robots for years anyway. Look at a Tesla factory, it's mainly robots. Yes, they do employ a lot of people, but not as many as it would have done if it was a car plant 30 years ago. So I think people just need to realize that the government wants to win the election, the midterms, really importantly, to put through the very strong agenda that they've been pushing, and therefore they will do anything for it. And the good thing is that means that us as ordinary people, or ordinary Americans, get bribed. If this is the year that the business cycle picks up, then you want to be long commodities, because that's what happens, and commodity currencies. So that's copper, the basic materials producers like Rio Tinto and those giant companies. They'll kind of do what gold did. They should break out because the business cycle's picking up. So you'll see that as well. If you start to see copper breaking heights, usually means the economy's strengthening. It's another good indicator people can use for the strength of the economy. So there's that cyclical stuff, which investors can look at. But if it's going to be liquidity driven, then crypto will do best. But technology is in a secular bull market anyway. So it's one of those years where you can pretty much point and shoot anywhere. Why do you get the period afterwards? Normally because interest rates go up afterwards and liquidity gets withdrawn. Because what gold is telling you is that A, there's debasement of currency going on, which we know, but that also the easing of financial conditions has been quite dramatic. So normally the economy then strengthens, commodities go up, and everything follows through, and eventually the central bank has to cut rates, has to hike rates and withdraw liquidity, and that's what causes downside. Doesn't necessarily mean it'll follow through. And the reason being is because we now use the money printer to stop anything becoming bad. Yes, we will get a bear market again. Yes, we won't get a recession because we don't allow collateral prices to fall far enough, because what we do is debase the currency, so optically makes the price of collateral go up. So that's why we've not, outside of the pandemic, which was 1 quarter recession, we've had no recessions. And it's because of this mechanism. since 2008, where we've just used the money printer every single time. So I don't think it's the same mechanism again, but it is the same thing, is the economy is broken, and so they keep printing money, so they're debasing the money away from you, but people don't realize that. And that's complicated, because if, let's say, 2027 is a bad year, they hike interest rates because, you know, inflation's rising a bit, they withdraw liquidity, market falls, okay, fine. They then come in and add liquidity, just like they did in 2022. What you then get is assets going to the moon again, because people then pretty much know the game. And you know, my thesis has been we end up in a spectacular blow off top in technology and crypto and all of this stuff, because everybody starts to understand what the game is. And that technology is so all powerful right now that it makes no money to it. It makes no sense to invest in anything that's not basically AI and blockchain.
Raoul Pal says Bitcoin should already be trading near $160,000 based on global liquidity trends, yet the market is behaving as if it's disconnected from reality. While assets like the Nasdaq followed liquidity models almost perfectly, crypto lagged badly, suggesting something inside the system quietly broke. Pal traces this disconnect back to October 10th, a strange session where liquidity suddenly thinned, market making stalled, and a wave of forced selling hit the market all at once. Someone had to absorb that supply, and the price never fully recovered from the shock. Pal suspects major exchanges, potentially including Binance, were forced to stabilize their own markets and ended up holding large inventories of crypto. Since then, those positions may have been slowly unwound, keeping persistent pressure on prices and dragging altcoins back toward their October lows. Zooming out, the picture gets even more unusual as liquidity drained instead of expanding, the debt cycle stretched, and broader macro stress tightened conditions further. If that's not the full story, then the real reason behind crypto's underperformance may still be hidden beneath the surface.
But I think we have one more cycle before that. And that's going to be the spectacular one. That's the blow off top cycle. Because right now, people are still cynical. They don't quite believe it all. So, you know, we saw like most of last year, most institutional asset allocators were underweight tech. Oh, it's a bubble cycle. I mean, there's no debt going into this thing, apart from a few companies. It's nothing. But people just don't want to believe that this secular change, this exponential change is happening. But if we, let's say, we have a good year this year, then let's say 2027, liquidity gets withdrawn a bit because we don't need to service any debts really that year. So we have the typical kind of down year. And let's say Nasdaq goes down 25, 30%, and Bitcoin goes down 50, 40, 40, 50, something like that. And we start the money printing cycle again, and Trump is ramping up to try and win the general election. We now know the playbook. Everybody's going, and we'll have gone from where we are in AI today to where we are in AI by 2027, which none of us can even predict right now because it's vertical takeoff. Everyone's just going to throw all their money at this. And then we'll have the boom in solar and energy and nuclear and all of the other things around it. I mean, for me, it's got all the elements of a full bubble blow off to come. But not this cycle, because people are too cynical about it still. And I don't want to get too speculative, but
well, we can.
For me, yeah, but for me, somebody ended up buying a lot of stuff that got liquidated, but the market maker APIs were basically closed. So it was difficult for a period of time for them to actually add liquidity. So who bought it all? So in my mind, the issue was really seen on Binance and some of the Asian exchanges. And my guess is somewhere amongst whoever, if your exchanges stop functioning and your market makers can't make prices, at some point you have to do something. So I don't know the structure of Binance, and nobody knows it. You know, do they have their own market makers within? Somebody probably got a lot of inventory, way too much inventory, because they had to. So if you've got a lot of inventory, it's like a program trading desk in equities that, you know, I used to work very closely with. They end up with a huge amount of inventory. They need to work it out over time. So what you don't want to do is just dump it immediately. So you just kind of do it every day, and try and not impact the market. But that would make sense why all of these altcoins went back down to that level, because a lot of people got carried out, there's no liquidity coming in the system. The entities or entity that bought a lot of this stuff now have to work out of the position. It takes time. And I think that was the feature of the after October, we saw that relentlessly in November and December. I mean, it's almost every day.
Mm-hmm. Yeah, it's like
now, we thought it was a market maker. Yeah, people thought it was winter mute or whatever. I don't know who. Probably everybody got a lot of inventory. So maybe it was 10 different players with a lot of inventory that needs to unwind it, because all retail investors got liquidated who were in leverage.
But Bitcoin is still stuck within the range of like 80 to 90K.
Yeah, and that's still because liquidity is not flowing. We have to go through the year end. All the banks have to do the window dressing. Now the SLR changes come in from January the 1st, but it's only January the 8th right now, time of recording. So nobody's doing anything yet. So these things take time to work out. So, Bitcoin is just reflecting the fact that there's no actual real liquidity in the market right now. And when it comes in, it'll lift off. And once it gets attention, it can play the catch-up, close those alligator jaws versus global M2, versus global liquidity, versus NASDAQ, versus, historic parallels. I mean, it just dislocated from everything because of what happened, right? So if liquidity gets withdrawn from the system and the government shuts down for the longest period of time in history, you have to change your plan. Now, my plan is I don't trade around stuff, so I don't care. My time is the cycle or multiple cycles. So it doesn't matter to me unless I've got some cash and I can reinvest into the thing. But people's time horizons are all different. That's the other issue, is because people want their money now. It's like money doesn't work that way. Only when you look back do you say, oh my God, I could have made that money in that period of time. Look at 2017. You made 10x in 6 months. Yeah, but at the time, was it obvious until it happened? No. So you just don't know. Nobody knows. Nobody has a crystal ball. But I know that the work on the everything code is as close to a crystal ball as I can get. But it doesn't make it tick for tick perfect, and it won't be. But it'll get it directionally right. 90% of all Bitcoin's price action is explained by global liquidity. So for that to be true, 2026 is a bear market year. It must be true that global liquidity is going to be falling.
Raoul Pal's outlook for 2026 centers on one core idea: liquidity is about to return in force. He believes political incentives will drive aggressive fiscal stimulus, rate cuts, and regulatory changes that allow banks to expand leverage and credit without relying on the Federal Reserve. As these mechanics take hold, financial conditions should ease, the dollar could weaken, and risk assets may benefit. Historically, gold reacts first, with Bitcoin following months later, suggesting the groundwork for a major crypto move may already be in place. With Bitcoin still trading well below Pal's estimated fair value, he sees this period as a rare window where traditional signals are aligning ahead of a potential surge. But Pal also warns this may be the final chapter of a familiar playbook. He argues 2026 to 2027 could mark the last traditional boom before AI fundamentally reshapes markets, capital formation, and investing itself. If that's true, this cycle may offer one last opportunity before the rules change entirely. So what do you think? Will 2026 be the year Bitcoin finally catches up to liquidity, or is the market setting up another painful lesson for investors? Share your thoughts in the comments below, and don't forget to like and subscribe for more deep dives like this. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.